Happy afternoon, everybody. It is Wednesday, August 10th, and I'm going to give you our monthly market updates. Finally, for a chance, we have some exciting news, positive news, so definitely listen in. If you have any questions, let me know. I am, of course, April.ranallo. I work for Fairway Independent Mortgage, where I am able to help families and individuals purchase or refinance in all 50 states. So let's get into it. How are things looking these days? Let me just share a little information with you guys. Actually, a bunch of information was just released this morning, which is great to hear. So this is extremely current. But the first thing I want to talk about is everybody is worried with talks of inflation, recession, that we're about to enter into another housing bubble, which is not the case. We're going to show you some information about why that's not the case, but a crash is not coming. First and foremost, we are looking at the fact that the experts are showing the reason that we will not be going into it is that the millennials, which are the largest purchasing population of homes right now, are just a large population. So they are likely to keep the prices high so that we don't have a massive decline in housing prices. Here's kind of a little grid to give you. Those millennials, like I talked about, born from 1981 and 1996, they are the largest population that are going to go purchase a home. We're talking 25 to 40-year-olds. What does that mean for us? That means that we need more inventory, which everybody is obviously aware of. Good news is, though, inventory is finally creeping up. This is going to give you a chart of where it's been at. If you notice that during the 2008 bubble, there was a ton of housing inventory. So supply and demand, once again, we had way more supply than we had demand, which is what caused prices to deflate so fast. Now, even though we are going into a new recession towards the end of the year, inventory has been low, but finally starting to creep up a little bit. Still not high enough, which will help the fact that we have more buyers than homes to sell. Another thing that we are looking at is lending standards. I've talked about this a lot during all of the various market updates I've been given, but I worked in subprime. Okay, you guys, I did those loans back to previous to 2008, where if you were breathing, you got a loan. That is not the case. With guidelines these days, requirements, and to be honest, just consumers being smarter shoppers, the amount of low credit, high income is far drastic now to providing mortgages than it was back in 2008. You see this very high June of 2007. We're talking, what is this, up to the 900s now. It has been stabled ever since and should continue to stay stable as far as what lending requirements are. The other thing I hear about COVID, tons of forbearance happened, modifications, special programs during COVID, which was obviously drastically needed with workforces changing, people being locked into their homes. But here's a current chart that was just released today that shows you kind of what has the results been from all of those special programs that were created. As you can see, 36% were actually paid back in full. I know myself that there was a lot of different clients that maybe took advantage of the program, just put the money in the bank in case they needed it. Gratefully, they did not need it. They paid it back. 45% of it, which is the biggest part, the lending institutions either came up with modification agreements for them or loan deferrals, where that 10, 20 grand, whatever may be in 2020, they just tacked onto the end of the loan so that they will just have a payoff later than originally expected. Now, 18% of them are still obviously having things to work out, maybe in trouble, etc. But it is not a high percentage of all of the modifications and help that were provided. So it should not cause us to run into a ton of foreclosures and short sales, things like that from back in 2008. Here is a very positive chart. Okay, this is talking about the recessions. Once again, yes, recessions are not great. You know, nobody loves inflation, Lord knows. But just because we're getting into a recession does not mean that homes are going to depreciate. Here is an example of 2008. Once again, a very large extreme over the last 30 years of what has occurred during the various recessions. Today, though, from 2020 on, we are still having a steady growth of appreciation in the values of the home. And we'll get into some more details of that. The positive thing of a recession doesn't happen right away. But when we fully go into one, mortgage rates will decrease. because with the recession, they are going to lower the rates, try to get the activity flowing again for people to purchase homes, cars, whatever it may be. So here is an example. The main thing I want to point out with this since the 80s, because most of us think 1980s is forever ago, not to mention your millennials weren't even born yet, half of them, or the majority of them. So let's look back into just for 2000s, the last 20 years. One thing I want to point out, and this is an education piece for most of your first time, even second time home buyers, is the rates were in the 6s to 7s back in the early 2000s, okay? So they're in a culture shock when we went up to the 6s, not to mention we'll see how fast they went up. But they were still better than they were 2 recessions ago, okay? Rates prior to 08, or in the crisis of 08, which according to all of these charts we're seeing was so extreme, we're still 5 to 6%. So the interest rates we have today right now are phenomenal. They're great. Once again, we had a little culture shock to go over, but they're creeping down. This is part of the positive news, but they're going to still go back to that range of what it was during 08, which is phenomenal, and over the last history, lower than they should be. This is giving you an idea of the difference or the amount that the interest rates lowered during a recession, okay? It was extreme, rates are higher, the dropping was more extreme, of course. But the big thing to see is that right here, we're looking at about an average of 1.8% is how much the interest rates lowered. So a couple months ago, they got up to the middle, upper 6s. We have already creeped back down to the upper 5s, lower 6s. So that 1 to 1.8% is pretty much right on point to follow where history has been for rates affecting or changing when a recession occurs. So what's our crystal ball? I always joke, guys, can't even see it, but I got a magic 8 ball on my desk, right? Because sometimes that's more effective than anything else that we have of where things are going to be moving. Here is the really fun positive side. Here is where interest rates have been since 2018. Okay, you can see the gigantic climb up Mount St. Helen here that occurred over the first 6 months of this year. Shot up, and we shot up quick, which all of us are aware of. But it should be a nice, steady, slow decline all throughout 2023. You can show that right now they're hoping in sometime in this fourth quarter, we're going to get down to the mid to upper 5s, and then maybe even get down to the lower 5s by the end of the year, which I can tell you we've already started seeing the decline. Housing forecast. Rents are still high and rents are going to still increase. So for those buyers of yours that talk about how they're going to wait for it to change, obviously we just talked about 4 reasons of how the market's not going to change and it's still a phenomenal time to purchase a home. And this is a big one. Rents have gone up 15 to 20%. They're expected to still continue to go up. And B, the appreciation we're going to look at is going to still increase. It may not increase this drastic amount that it did over the last 12 months, but it will still be a nice steady 3 to 4%, which means money in their pockets. Here's the example. $500,000 home, you're putting down 10%. You're still going to get that nice 4% appreciation, meaning you're getting a 40% return on your income. Stock market is not giving any return right now. We all know the stock market's down. So buying a home is the place to put your money to make money on your money. A lot of things that people have said is that, or just my buyers themselves, they're discouraged, right? It's been a rough 6 months. They've been beat up. They've had to claw and compete with 30 people to have a chance of that possible one home. But it's starting to shift around between obviously my agents updates, just what we're seeing out there. There's less offers being received, a little bit less competition, and inventory is starting to creep up. Now, don't mistake the less offers and less asking, offers over asking price to mean you can negotiate into buyer's market and you can strike a deal. Not the case. Hopefully, it's just a matter of, as the professionals or the experts say, it's more a matter of just a silver lining that people that were frustrated will get back into the market. They'll maybe only have a little bit of competition. They'll maybe have more than 20 minutes to make a decision of whether they like the house. Like they can decide in a day of whether they like the house or not. And with rates creeping back down, it's just a good positive, like, okay, take advantage of the lower the lower of the interest rates while you can before they could possibly change. Home sales have returned to before COVID levels, which is why we're also seeing an uptick of, the inventories increasing a little bit, primarily because, in my personal opinion, which is that people got frustrated, took a break over summer. It's very common for us in the fall to see it pick back up right before the holidays, right? So call those people back that did not buy a home in the last 6 months. Inventory. Once again, inventory is under 6 months availability, which means that we are still very much in a seller's market, but it's creeping up. This is just to show you, once again, another sign of hope from December to March, it was really rough, okay? And we're doing a slow, steady incline for inventory to improve and to help your buyers have a few more options out there. This is how drastic it was. Originally, they expected our inventory level to basically be non-existent, okay? Now that we are a good halfway through the year, the forecast for the inventory is to be up by 15%, which is why we get this. Finally, a blue bar. This is the inventory levels that we've had over the last 12 months. As you can see, it's been low, 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 low. Now in June, may not be a drastic percentage of the inventory, but it is in the positive side of it, and it is creeping up. So get those people on the MLS search list to make sure they see what is active, what's coming out there. There's a couple of slides I have in here for my agents. Any of your clients that you have that maybe want to take this information and give it to them, it's great. I'm happy to talk to them as well. But here is some proof of why you should still purchase. Number one, like I've mentioned, people were kind of discouraged with the competition levels. As you can see, in April versus June, it was about 5.5 offers versus now we're down to the low 3s. Asking prices, yes, offers are still going for list or even going above list. Like I said, this does not mean that we have a drastic shift of it being a buyer market versus a selling market, but it is a more comfortable competition type of a market. So the amount that are going, the extremes we had are much lower as far as, 50,000, 100,000 above asking price, that where it got a little crazy out there. And once again, not to repeat, but we got more inventory coming. What all that means is that some people are noticing that there is list prices that are actually decreasing, right? Because they didn't sell in 48 hours. They've decided to reduce the listing price. Seeing listing prices decrease does not mean that homes are depreciating. Once again, it just means that the competition is changing a little bit and you got to change your strategy. So if you can't tell, 2022 here, we had a very large increase in the prices, which once again, not a newsflash. But what I like to see, which is even better, of why you would still purchase a home now is you are still going to get a steady growth of appreciation, anywhere to 3 to 4%. Not to mention your rents are increasing. So for you to rent versus buying a home, you're going to be losing on all the appreciation. The market is not going to shift where all of a sudden it's a buyer's market in the next few years. And you'll be throwing away all of your money that you have been spending on rent. See here, it says tangible assets like real estate get more valuable over time, which makes buying a home a good way to spend your money during inflationary times. Because you are going to be gaining money on your money, it will help keep up with inflation in every other aspect of your life. Creativity, it is my strong suit. I always say my superpower is round peg, square hole. If you are having any clients that are just having difficult situations, I've been dealing with a lot of clients that are just needing help with how to navigate through selling a home, buying a home, moving, packing. It's all a lot and a lot of things to be stressful about. Here's a few things I can help explain more or give options to. A lot of clients are not aware that a bridge loan is available, essentially a loan that you can take on the equity of your current home. And then that way you can close on the new home first. Then you go ahead, sell your existing home, gives you a few weeks to have time to pack the family, move the family, not have to have all the stars align within a 24-hour period. And then when you sell the home, those loans are all paid off, okay? There's a recasting. I have a client right now that has the cash available to have the down payment on the new home, but ultimately wants to take advantage of all the equity that they have in their current home. Not a problem. They are taking the current cash that they have They're going to go ahead and purchase the new home with a smaller down payment than they initially wanted, right? They're going to put down 10%, 20%, whatever maybe. Move in, life is great. When their current house sells, they're going to take that extra big chunk of cash that they originally wanted on the new home, and they're going to pay down the principal balance of that new mortgage, allowing them to do what's called a recast, in which case the servicer will just reevaluate their monthly payment based on that new principal amount, and they get exactly what they want. In the end, they just had a couple month delay to make their life less stressful and easier. Couple reminders, Fairway Independent Mortgage, we do have our cash guarantee that we're able to provide, where we will state that the buyers can give the sellers a guarantee that they will close on their closing dates. Nothing financially related can go ahead and cause it to fall apart. They lose their job, they buy a car they weren't supposed to. We will guarantee that we would then buy the home in cash or give the seller the option to get $10,000 to walk away from the deal and relist. Super great option. And lastly, timing. Timing is always key whenever you're negotiating. So for those deals that either A, fell apart at a different lender and you need to save the day, or B, the sellers are just looking for a short close. And the way for your offer to be accepted on a short close is for us to do an advantage pre-approval. We will get the file fully underwritten, pre-approved, so that when you get the contract, all we need is title and appraisal, and we can close extremely fast. Here's just a little rainbow, the more you know, kind of a situation. Right now, when the market slows down, leads are sold. Okay, so you are going to hear your clients talking about filling out mortgage applications, and then they're getting bombarded with calls the next morning of, hey, I can help you, would you like to compare, et cetera, et cetera. How that is occurring is the credit bureau companies sell leads. It is not the mortgage company that person is applying for. So when the Equifax, Experian, TransUnion, when they see a mortgage inquiry has been pulled from a mortgage company, they will sell that lead to, Lord knows, 20 other places, in which case your information is given and you will start to get the phone calls and the emails about, it's like filling out your information on LendingTree. You're going to get all these options, which most of your clients don't want. They may shop, which is great, but they'll just call the 2 to 3 people either you suggested or that they know. So here is the information. They can go online and opt out for 5 years. They have an option where they can permanently opt out. The biggest thing is to enter in your cell phone. A lot of people back in the day entered in an opt-out option for their home phone, which is gone. Nobody has their home line anymore. Actually, I did talk to somebody earlier today that still had a voicemail recorder. But have them fill it out. Once again, just the information to save a little extra nuisance that they have. Here's my contact info. First QR code is all of my information, which is obviously here. Give me a call, happy to talk, text, email, whatever it may be. I do these monthly market updates every second Wednesday of the month. So keep an eye out for the next one. And beyond that, check out my website. I do a ton of events, different events. I do a lot of charity events, things like that. So if you ever want to know where I'm at, if you want to join in on volunteering or another networking event, if you're in the real estate profession, or even if you're just a client, give me a call. Thank you guys for listening. Hope you have a fantastic month and enjoy the rest of the summer. See you after school starts. Bye.